Welcome and thank you all for standing by. At this time, all participants are in listen-only mode. This call is being recorded. If you have any objections, you may disconnect at this point. I'll turn the call over to your host, Mr. Ben Johnson. Mr. Johnson, you may begin.
Johnson, Morningstar's Director of Global ETF Research, and I would like to thank you for tuning in. Today, I will be discussing some important developments that will enhance two of the most important signals that we as a manager research organization send to investors around the world: our Morningstar Analyst rating for funds and the Morningstar rating, also known as the STAR rating. These enhancements will help investors around the world make better decisions when it comes to selecting the funds that will ultimately help them to achieve their long-term goals. Here's a quick snapshot of our agenda. I'm going to begin today by providing some background on our global ETP, or exchange-traded product, research effort. From there, I will discuss the impending launch of Morningstar Analyst ratings for ETFs. Specifically, what I'm hoping to cover is, first, our rationale for including ETFs in the Morningstar Analyst rating framework. I'm going to provide a high-level overview of our methodology. I'll walk through our output, the Morningstar ETF report, and I'll share with you our initial coverage targets. Finally, I'll also discuss the concomitant changes that we will be making to the methodology which underpins the Morningstar rating. So without further ado, let's get underway. First, I'd like to provide you with an overview of our global exchange-traded products research effort. Morningstar has approximately 115 research analysts worldwide who cover approximately 4,000 funds. Our global exchange-traded products research team is embedded in our global manager research team and includes 15 analysts scattered across our global offices. At Morningstar, data is our bedrock. We have a comprehensive global database that includes information on thousands of exchange-traded products that are listed around the world. As for our manager research effort, we've been conducting qualitative research on exchange-traded products for over 8 years. Now, on September 8th, of 2016, we announced that we will be introducing Morningstar Analyst ratings for some 300 ETFs listed in the US, Canada, Europe, and Asia later this year. I'd like to share with you some insight into our rationale for including ETFs in the Morningstar Analyst rating framework. Now, as is the case with everything we do in our manager research organization, our overarching objective is to help investors to make better decisions. Thus, we want to ensure that our own frameworks are well aligned with investors' decision-making frameworks. What we have seen in recent years is that investors' opportunity set and thus their decision-making frameworks have been evolving quite rapidly. As can be seen here, most investors do not have a black or white, active or passive view of the world. In fact, investors are becoming increasingly strategy agnostic, looking to select best-of-breed strategies irrespective of where they might be located on the active to passive continuum. Additionally, investors are also becoming ever more vehicle agnostic, and fewer every day show a strong preference for traditional mutual funds over ETFs or vice versa. Again, investors are looking to select the type of vehicle that best meets their needs. This is evidenced by the continued growth of assets under management in ETFs around the world. In the graph I've included here, you can see that ETF's share of the U.S. funds industry has gone from nil prior to the launch of the SPDR S&P 500 ETF in 1993 to 15% as of the end of 2015. Furthermore, We expect that these trends will only continue and might even accelerate over time. This will be driven by a combination of investors' growing familiarity with the ETF wrapper, continued expansion of the menu of ETFs and other exchange-traded products, such as Eaton Vance's NextShares, intergenerational transfers of wealth, and regulations, such as the fiduciary standard in the U.S., RDR in the U.K., and the future of financial advice in Australia. The exhibit above, which I've taken from Charles Schwab's recently released 2016 ETF Investor Survey, is a testament to how investors' growing familiarity and intergenerational differences in investors' proclivity to use ETFs will likely drive further ETF adoption in the future. So investors' decision set is becoming ever broader and ever less restricted. When it comes to selecting funds, investors are making decisions in a manner that is increasingly strategy agnostic. That is to say, they are looking for best-of-breed funds irrespective of whether their underlying strategy is active, passive, or somewhere in between. Furthermore, investors are becoming increasingly vehicle agnostic. The decision between traditional mutual funds and ETFs is now arbitrary for many investors who are simply looking for the most efficient wrapper to meet their needs. In sum, investors are now selecting funds from a field without fences. By incorporating our ETFs into our Morningstar Analyst rating framework, we are leveling the field and taking down legacy fences to help investors to pick the best funds from an ever-expanding menu of both strategy and vehicle types. So now that I've covered our rationale for including ETFs in our Morningstar Analyst rating framework, I'd like to walk through the methodology that drives our ratings at a high level. Before I get into the specifics of our methodology, it's important to understand the manner in which we rate and rank funds and how this has evolved with time. The Morningstar rating, which is a quantitative ranking of risk-adjusted returns, dates all the way back to 1985. Morningstar hired its first fund analyst, Don Phillips, in 1986. But it wasn't until 2011 that we introduced our forward-looking Morningstar Analyst rating, bringing together our research process into a single, harmonized global system. So as many of you likely know, the Morningstar rating, or star rating, is a strictly quantitative, backward-looking measure of a fund's risk-adjusted performance relative to its category peers. It tells investors how funds have fared. It is an achievement score. The Morningstar Analyst rating is a qualitative assessment. It is forward-looking and summarizes our assessment of a fund's prospects for future risk-adjusted performance relative to category peers. It is an aptitude test. Our gold, silver, and bronze or medalist ratings are all positive ratings. Our medalist ratings indicate that we expect a fund to outperform its peers while accounting for risk over a full market cycle. The cascade from gold to bronze represents our level of conviction in our overall assessment, with gold-rated funds being our highest conviction positive calls. Now, in conducting our due diligence and forming our opinion on exchange-traded funds, we will be applying the same framework that we have used to rate mutual funds since 2011. Specifically, we will be scrutinizing and scoring the same 5 pillars that underlie our current ratings collection. These pillars are people, process, parent, performance, and price. Now, it's important to note that we will place varying degrees of emphasis on these pillars depending on the case at hand. So, for example, in the case of index mutual funds and ETFs, we will tend to place a lesser degree of emphasis on our people pillar than we might in the case of a large cap value fund that's running a concentrated portfolio with a lone, long-tenured manager. However, that is not to say that people are unimportant when it comes to managing index funds. In scrutinizing ETF and index fund management teams, we place emphasis on things like experience, asking ourselves how long has the team or the managers managed ETFs or index funds, asking whether or not indexing is a core competency for the sponsor firm. We also look at team structures. We want to see a diversity of experience, a diversity of talents, from traditional portfolio management capabilities to trading. We want to know whether or not there are ample redundancies. In the case of global portfolios, we want to know what the geographic dispersion of that team is. Are they trading local markets in real time during local market hours? Do they have those capabilities? Moving on to the next pillar, process. I would say that process is one of two pillars that will receive the greatest degree of emphasis in our assessment of index mutual funds and ETFs. And our assessment of these funds process cleaves into two big picture questions. The first of which is, how is the index underlying the fund built? Because index construction in the context of an index mutual fund or ETF ultimately defines the process, defines the strategy, and the characteristics of the benchmark, the way in which it is constructed, will yield the end product, which is the risk and return profile of that particular portfolio. So we look at the underlying indices and we ask ourselves whether or not they are representative of the opportunity set that's being exploited by their category peers, whether these indexes are objective in the way that they are built and maintained, or if there's an ongoing element of subjectivity or discretion. We place a premium on transparency with respect to index methodologies, and investability is also something that we keep a very close eye on. We ask ourselves, does the index, as is the case with, say, a total stock or a total bond market index, seek to measure the performance of an asset class? Is it a broad market barometer? Or does it, in some cases, increasingly, seek to alter the risk and return characteristics of a standard benchmark, mimicking strategies that have been employed by active managers, exploiting factors that have been exploited by active managers for decades, what we would call strategic beta, what others might call smart beta. Now, having gained an understanding of the details of index construction and what they imply for a fund's risk and return profile, the second big picture question we ask is, how is the fund constructed and managed to track its index? What is the replication method that is utilized by the manager? Are they owning physical securities? In some cases, particularly relevant in the European context, are they synthetically replicating the underlying benchmark, obtaining the performance of that index via a swap arrangement? We also want to look into things like dividend reinvestment, securities lending policies and practices, as well as, in the case of ETFs, how the ongoing process of creation and redemption of new shares is managed. All of these elements are crucial in understanding how these funds are managed to deliver high-fidelity tracking of their underlying index. Now, of course, as has long been the case, stewardship is an absolutely critical input into our assessment of funds' investment merit, irrespective of the type of fund in question. Our big picture question that we're looking to answer here is really cultural. We want to understand whether or not fund sponsors are good stewards of shareholders' capital, if they're aligning themselves in a way that is fully in tune with delivering the best possible outcomes for their shareholders. Now, in the case of ETFs, we also want to understand what sort of ancillary services the ETF sponsor provides. ETFs cannot live and breathe in isolation. It takes a village to raise an ETF, it takes the ETF ecosystem. We want to understand whether or not ETF sponsors are actively engaged with index providers, with the market-making community, with all of these various villagers who, in combination, foster a positive investor experience, particularly with respect to the trading element of buying and selling in an efficient and particularly in a cost-efficient manner shares of exchange-traded funds. Now, the next pillar that we examine is performance. In the case of index funds and ETFs, we look at performance through two lenses. First, we scrutinize these funds' tracking performance. How well, historically, have they replicated the performance of their underlying benchmark? What you'll see is that in most cases, high-fidelity tracking has become table stakes when it comes to managing exchange-traded funds or index mutual funds. Secondly, we assess how these funds have performed on both an absolute and peer group relative basis across historical market cycles. We want to understand how these funds have fared against their peer group, and again, that is a peer group that is defined across varying types of strategies, active, passive, and in between, and now across various types of vehicles, be they traditional funds as well as exchange-traded funds. Now, I mentioned earlier that process was one of two pillars that will receive the greatest degree of emphasis in our assessment of index funds and ETFs. The second is price. Many, but certainly not all, index funds and ETFs have a meaningful cost advantage over their peers. A low fee is arguably the most meaningful and reliable competitive advantage that a fund can possess. As such, it is a key input into our analysis. Now that I've discussed some of the particulars of our methodology, I'd like to quickly walk through our research output, the Morningstar ETF report. As I mentioned before, we first began producing qualitative research on individual ETFs over 8 years ago. Today, our output resides in the Morningstar ETF report, which is disseminated through all of our major software platforms as well as our global websites. I should emphasize that the screenshots of the report that I'm sharing here reflect its current format. The New Look report, which will be launched in conjunction with our analyst ratings, will feature our rating, our individual pillar scores, and our Morningstar take. The take being a summary of our assessment of the fund's investment merit. I've included the full report here for your reference, but I certainly don't plan to cover each page in full detail. So lastly, with respect to the Morningstar Analyst rating, I'd like to share with you our initial coverage targets. Later this year, we will be unveiling ratings for nearly 300 ETFs listed around the globe. I would like to emphasize that this is just our initial wave of coverage and that we will be expanding our rated universe over time. We've already identified subsequent waves of funds that we would like to include in our ratings framework, and our long-term targets will be roughly double what you see listed here. So as we set out to level the field with our forward-looking analyst ratings, we're simultaneously leveling the field with our backward-looking Morningstar rating. I'd now like to touch on the forthcoming changes to the Morningstar rating, or the star rating. Again, the Morningstar rating, or star rating, is a strictly quantitative, backward-looking measure of a fund's risk-adjusted performance relative to its category peers. In the U.S., we've seen, as well as a number of other peer group relative calculations, we have ranked mutual funds on the basis of their historical Morningstar risk-adjusted returns and drawn the distribution curve that precipitates the star rating across this ranking. ETFs have then been subsequently slotted into this distribution for purposes of calculating their own star ratings. Fast forward to 2016, and we now have more than 1,900 exchange-traded products that are listed in the United States. And in the case of some Morningstar categories, ETFs actually outnumber their mutual fund peers. This development has made it vital, important, essential to combine these peer groups. Again, this is in line with our overarching objective of helping investors to make ready comparisons across a wider variety of strategies and vehicles, as it will yield more sensible peer group relative metrics, and it also harmonizes our methodology globally. Lastly, what I'll share is just one example of an issue that will be solved by combining these legacy peer groups. The case in point here being a side-by-side comparison of the peer group performance ranks historically between the Vanguard Total Stock Market Index ETF and the Admiral share class of the fund, which many of you may know is simply just two separate share classes of the same fund. And what you can see here, especially if you look at the trailing 1, 3, and 5-year performance ranks for each, is that you have, given the differences as it stands today in their peer groups, one being ETF only, one being mutual fund only, very different ranks for what is the exact same fund, with the mutual fund share class performing apparently quite better relative to its peers versus the separate share class, the ETF share class, which is being ranked against a narrower peer group in the large blend category that contains ETFs exclusively. So again, just one example of many of why this change is important, how it will facilitate more ready comparisons, how it is going to be better reflective of the opportunity set that is available to investors, and how that has evolved and will ultimately, we hope, increase the type of chassis that strategy is being bolted onto. So with that, we've come to the end of my formal remarks. I would encourage you, now that we have about another 10 minutes available for questions, that if you have any questions, to please submit them using the Q&A function that you'll see available on your screen. I will give it a minute or two to allow you to send along some questions. And one question that has certainly been, I think, the most frequently asked question that we've received to date regarding the changes to the Morningstar rating or the star rating is how this will affect the ratings for funds specifically. So certainly, depending on the category in question, holding all else equal, one would expect that the introduction of a large number of very low cost would have the mutual funds that are now being combined into that same peer group. What I would say is that holding all else equal, certainly that would be the case, but in this particular instance, there's another important change to our methodology that is taking place that will offset that. Specifically, what we are doing is we can discuss of shares. So what you will see is that these are two sort of countervailing forces. In the one direction, the addition of a large number, in some cases, of low-cost peers into a combined peer group, but on the other hand, the removal of concerns, that being this historical load adjustment. So what we've seen in the preliminary analyses that we've run is that many, if not most, ratings remain unaffected given the netting effect of these two forces, and if there are any impacts, these of dollar. So the other question that I'm getting here would be a follow-up question as availability of the sample ETF report that we've shown in the presentation. What I'd say is I'd be more than happy to share both. If anyone is interested in receiving either, you're more than welcome to follow up with me or any interest in receiving either the slide deck or a sample ETF report. I would be happy to provide that. The next question that we're receiving is, when will the change go into effect? Now, the changes to the Morningstar rating or star rating will take effect as of October 31. So that is coming here just in the next few weeks. Again, those changes not affecting just the star rating, but all of those peer group relative calculations, the performance rankings from the example I shared earlier, just being one of those that will also be affected. So another common question that we're receiving, so will the ratings be only for passively managed or index tracking ETFs? Will they be active, passive? Will they cover strategic beta as well? Again, we are moving in a direction that is strategy agnostic. So our coverage list is really defined by a combination of investment merit, which is somewhat subjective and is subject to our analysis and our opinion. The other being investor interest, which is readily gauged using things just like assets under management. So we have no plans to discriminate between active, passive, and those strategies in between. I would fully expect that long term we will be covering a sampling of all of them. Again, directionally, where we're headed is to a place where we're no longer, making these distinctions or drawing boundaries in terms of where our rated universe might begin and end, as defined by strategy type, as defined by the type of vehicle in question. The other question that I'm getting, so the load adjustment removal will only affect load shares. So the question is, will it only impact load shares? That is correct. The comment embedded in that question is that the industry is moving more towards Class I shares, absolutely. And what we see and what is evident in the data as well is that fewer and fewer investors are actually paying loads. So the removal of that load adjustment is really sort of bringing us in line with the reality of investors' actual experience, which is that a small minority today who are purchasing new funds for the first time are actually paying loads. So that is part and parcel of the thinking behind the removal of that load adjustment. So with that, it looks like we don't have any further questions. Again, for anyone who's interested in receiving either a copy of the presentation or the sample report, you're more than welcome to email me directly at ben.johnson@morningstar.com. I want to thank everyone again for tuning in to this webinar, and I hope you enjoy the rest of your day.